So, today I'm going to talk about credit crunch. We know that it is a new financial management term. I will explain it in a simple way. Imagine you need a loan to buy a house or start a business. Suddenly, banks stop lending money. That's what we called it as a credit crunch. So, we can move on to introduction part. A credit crunch is a financial situation where banks and lenders reduce the availability of loans, making it difficult for individual and business to borrow money. It happens due to the economic instability, bad debts, or changes in government regulations. So, when a credit crunch occurs, business struggle to expand. It may cause job losses or stock market crashes and even financial crisis in the economy. So next one is why it is important. Why the credit crunch is important in an organization as well as the economy. We know that the credit is the backbone of the economy. In first point, business struggle to grow, which means that companies need loan to expand. But if they cannot get money, they grow slow down, which shows that credit crunch is important in a business. That is first point, that is business struggle to grow. Second one is people face difficulties. It becomes harder to get loans such as business loans or home loans. It makes very difficulties. So it means that people face difficulties if credit crunch is not there in an organization. So third one is economy slowdown, which means that when lending reduces, people and business spend less. It leads to weaker economy and possible recessions. When lending reduces, people and business spend less and leading to a weaker economy and possible recession. That is what the economy slowdown. Fourth point says that past crises show the danger. Even like 2008 financial crisis show that credit crunches can cause major economic problem worldwide. So these are the 4 points while the credit crunch is important in an economy. So next we can see about the causes of credit crunch. Several factors contribute to credit crunch. First one is excessive risk taking by banks. Second one is asset bundles and crashes. Third point is that high default rates. And fourth point is regulatory changes. And fifth one is global economic uncertainty. So we can discuss it one by one. So first point is excessive risk taking by bank. Here, when banks lend money carelessly, they accumulate bad debts that cannot be repaid. That causes the credit crunch. That's about first point, excessive risk taking by bank. Second one is asset bundles and crash. A bundle forms when asset prices rise too high due to speculation. When it is like a 2018 housing bank crash, that financial panic spread over. Here it's meant by asset bundle and crashes is a second point that due to the causes of credit crunch. Third one is high default rates. That if too much or too many borrowers fail to repay loans, bankers suffer losses and stop lending. This is meant by high default rates. So, the high default rates causes to the credit crunch. Here, the fourth point is regulatory changes. Government may introduce strict bank rules or making it harder for banks to lend freely. It's meant by regulatory changes. It causes to the credit crunch. That's about fourth point. So, last point is that global economic uncertainty, which means that when a recession fears rise, banks hold into their cash instead of issuing a new loan. That regulatory changes as well as the global economic uncertainty. Here the global economic uncertainty causes the credit crunch. So these are the 5 main factors to the credit crunch. So next one is effects to credit crunch. So when banks stop lending, the impact spread across the economy. There what it happens. First one is business struggle. That we know that companies cannot borrow money to expand, leading to slowdown, which means that business struggle. Second point is that job losses. That business cut costs and people lost their jobs. That is meant by job loss. And third point is that stock market decline. That investors are panic and start selling the stocks, causes a stock market to crashes. So that's meant by stock market decline. And fourth point is that housing market collapse. If banks stop giving home loans or property price drops, it leads to housing market collapse. So fifth point is that government bailouts, which means that governments often have to stop in and give money to banks to stop their total collapse, which means that these are the 5 effects of credit crunch. First one is business struggle, second one is job loss, and third one is stock market decline, and fourth one is housing bank collapse, and fifth one is government bailouts. Here a perfect example is it was on the 2008 financial crisis. So next one is how to prevent the credit crunches. So to avoid another credit crunch, several steps are taken. First one is stronger banking regulations. So here the government must enforce rules to ensure the responsible lending. So first one is stronger banking regulations. It's the first point to prevent the future credit crunch. Second one is risk assessment models, which means that banks need better risk evaluation before improving loans, which shows that credit assessment models. It's a second step for preventing future credit crunch. Third one is government and central bank rule, which means that they can provide liquidity in times of crisis to stabilize the economy, which means that government and central bank rule. It's the third step for preventing future credit crunch. So, fourth one is diversified lending portfolio, which means that banks should not rely too much on one sector. For example, should not only in real estate or stock market investment. It's the fourth way of preventing the future credit crunch. So these are the 4 steps for preventing future credit crunches. First one is stronger banking regulations. Second one is risk assessment models. And third one is government and central bank rule. And fourth one is diversified lending portfolio. So last we can say about the conclusion. So a credit crunch can have a serious consequences, slowing economic growth, increasing unemployment and creating a financial instability. To prevent this, bank must to practice responsible lending and government should enforce strong financial regulations and risk management strategies can help business and individual to navigate such crises. And central banks also play a crucial role by using policies like quantitative easing to support the economy. By learning from past financial crises, we can build a more stable and resilient financial system in future. Thank you.